Hello, and this is TIO Markets. I'm John Noble, and today we're going to do an introduction to MACD. MACD is the moving average convergence divergence. But before we get into the juicy material, take a moment to read the disclaimer. It's very important. So at this point, you may pause the presentation and read through the disclaimer, and then we will proceed. I'm John Noble. I am a professional trader and analyst for more than 21 years. I've started my career in New York as a financial advisor for Morgan Stanley. I qualified to manage futures funds, commodity trading, operate commodity pools by the U.S. National Futures Association. And I am a certified portfolio manager and investment advisor by the Cyprus Ministry of Finance. The MACD indicator. So what is the MACD? Well, if by now you should be familiar with price action and momentum. Momentum is the force or the strength of a price moving either higher or lower. So what the MACD aims to achieve, it's to help you stay on the right side of the trend, and it measures momentum. It's not measuring price. It's measuring how strong the momentum is behind the price, and whether or not price is weakening or if price is gathering strength. So momentum, like prices, moves in a trend. So momentum will trend the same way that price trends. The MACD shows the relationship between two moving averages. That's the difference between the 26-day moving average and the 12-day moving average. So the MACD is applied to charts. And this is key here, and this is what a lot of you are looking for, is that the MACD will be, if applied correctly to charts, it will show you buy and sell opportunities. So the next slide here, we're seeing how to find the MACD on the MT4. Most of you are familiar with the MT4 platform. Some of you are beginners. So how you can find and apply the MACD is once you open your MT4 platform, you go to Inserts, Indicators, Oscillators, and select MACD. So just to show you in an actual environment, we will go Insert, Indicators, because MACD is an indicator, select MACD, and there you go, your MACD will be represented in the charts. So here, let's just remove one of the excess MACDs as a demo. And we'll move on to the next slide. So there are three ways to use the MACD, and one is for crossovers. That is when you see the MACD will provide a signal on a crossover, and here you can see the MACD is in the gray bars. Let's highlight that a bit for you with our arrow. So these gray area is your MACD, and the red line we have here is the signal line. So a MACD crossover would be that signal for a buy would be when the MACD crosses above the signal line. Let's get into that in just a few seconds. Overbought and oversold conditions and divergences. So let's get a little bit more detail into the crossover. So the next few slides, we're going to speak about crossovers, overbought, oversold conditions, and also divergences, and how they can generate buy and sell opportunities for the chartist using the MACD indicator. So MACD crossover, the basic trading rule is to sell when the MACD falls below its signal line. So here we can see price. So this area of the chart is price, and this is our MACD indicator. So the MACD will provide a sell signal when the MACD crosses below its signal line, which is the red line here, and a confirmation of that would be if price falls below the zero line, which is this baseline here, the darker color or black horizontal line. So and the MACD is a leading indicator, so it will move before price is going to move. So that's important to understand. Now, the buy signals will occur when the MACD, it's the opposite of the sell. So a buy signal will occur when the MACD rises above its signal line. So here you can see a buy signal. Let's highlight that for you again. You can see that the MACD, the gray shaded bars, crossed above the red line. That was our buy signal. And then here you can see price on or about when we got that signal and how it reacted. And then we've got this consolidation area here. Let's highlight the consolidation, and then you can see also how the MACD is performing here. So here your buy signal would still be valid, and or you would even be you'd see another sell signal here, but we're speaking about the buy side. And then you get a confirmation that the trend is continuing to move when the price crosses above its zero line. We'll get into the zero line and what it means in just a few more slides. So this is the MACD interpretation for crossovers. It's that buy signals will occur when the MACD rises above its signal line. So here we can see the signal line is always set to 0. So this black line here, where you can see the MACD is oscillating from above and below, this is your 0 line. And you can see how when price reacts, the 0 line acts more of a confirmation in an uptrend and a confirmation in a downtrend. MACD sell signal, here you can see what happens when MACD crosses below its signal line, which is the red line, and then you got a confirmation of that here. Again, you'd have a buy level, a buy signal, and then there's confirmation when the MACD and the signal both cross above the 0 line. Overbought and oversold. So the first is a MACD crossover, which we've just explained. Now we're going to go into overbought and oversold. So MACD in overbought and oversold conditions. So MACD is useful as an overbought and oversold indicator. So this type of MACD analysis, it's more of an art than a science. So here you can see, and I think it would be better if we can put it, we could actually show you these conditions on a chart. So this is our MACD here, and let's, on a daily chart, let's put it out here, and we can, here you can draw the overbought and oversold by connecting tops. Here you can see if we put this line here, we can make this the upper end of the MACD, the red line here, and here you can see that we're connecting the tops of the MACD over a period of time, and we can do the same on the bottom. We can connect the lows over a period of time. You might want to change the colors to help you make more, give yourself a more visual experience. And here we can see how price is reacting in this area of overbought and oversold. So here we can see the MACD at a peak being oversold, and you can see that the price is also here. And then on oversold areas, we could actually see it in this move here. Well, this was a divergence here. So this, we're going to get into that in the next one. But what we see here is a divergence, which is something we need to be careful of. So these type of divergence can although we're seeing an oversold area because of this divergence, it's actually it's going to show that prices will continue to go lower. So this will give you a false move here. But for a short-term trader looking to take advantage of this move here, you can see how the MACD worked very nicely, but it failed to reach the upper ends here. So then that will be a warning here, maybe to close the position if you see if the signal of the MACD fails to reach a new high. Divergences. Now, the divergences will provide a lot of clarity to the crossovers and the overbought and oversold examples that we have just gone through. So MACD divergences, and what are they? A MACD it's a useful indication that an end of a trend may be coming. So you're going to be looking for divergences to help you identify if an uptrend is coming to a close or a downtrend is finishing. So the MACD divergences is a fantastic tool to give you some insights and a heads up of for what's to come. So bear market divergences, they will occur when the MACD is making a new low while the prices fail to make a new low, and bullish divergences occur when the MACD makes a new high while prices fail to make new highs. So both types of these divergences are most important when they happen at the relatively overbought or oversold areas. So let's get into this, because for me as a trader, the MACD divergences is the most powerful. So here we go. This is a MACD, a bullish divergence. So a bullish divergence occurs when the MACD makes a new high. So let's stop right there and let's get into MACD, new high, while prices fail to make a new high here. So we've got new high, prices fail to make a new high, and this gives us a bullish divergence. So when you see this type of a divergence, it's a good indication that the downtrend is now nearing an end, and that prices will then accelerate and go higher. And then we can see what happens after that divergence. So again, just to summarize this, that a MACD bullish divergence is when you see the MACD making new highs, and you're getting prices are not making, or you're not getting they fail to make a new bottom. You can see here prices stopped here and here, but we didn't get a new bottom and that divergence. And then a trend follower, which is measuring momentum, would then be able to participate in this move. And for the last slide on MACD divergences, we're going to look at the opposite of a bullish divergence, which is a bearish divergence. And bearish divergences occurs when MACD makes new lows while prices fail to make new lows. So here again, it's the opposite of what we've seen on the bullish divergence. You have price failing to make new lows because you've got 1, 2, and then you get to move up, and then a continuation of the downtrend, and you've got MACD at new lows. Very powerful stuff. The moving average convergence divergence is a momentum trend followers traders go-to tool. So if you want to know or you want to measure the strength of trends, there is no the MACD, in my opinion, is a very versatile tool to use. and it's worth investigating it a bit more further. So any questions you could ask TIO Markets about for more information on the MACD indicator. So the conclusion here, the MACD is a trend following momentum indicator, and there's three ways to use it: crossovers, overbought, oversold levels, and divergence. Again, questions on MACD, contact TIO Markets to find out more. Thank you, and good luck trading.